Starting small with low-risk investments like index funds or ETFs is one of the most reliable strategies for beginners who want to grow their money steadily without exposing themselves to unnecessary risks. When you only have a limited amount of money to begin with, such as $100, it is important to focus on investments that spread your money across many different companies or assets at the same time. This is exactly what index funds and exchange-traded funds, commonly known as ETFs, are designed to do. Instead of placing all your money into a single stock, which can rise or fall dramatically in a short time, index funds and ETFs pull money from many investors and invest it in a wide basket of stocks or bonds. For example, an index fund that follows the S&P 500 gives you exposure to 500 of the largest companies in the United States with just one investment. This way, even if one or two companies perform poorly, the impact on your money is limited because the overall growth of the entire market supports your investment. Another advantage of starting with index funds and ETFs is that they often have lower fees compared to actively managed funds. Because they simply track the performance of a market index rather than trying to beat it, they require less management and therefore cost less. Over time, these savings in fees can make a significant difference in how much your money grows. For a beginner with only a small amount to invest, avoiding high fees is extremely important. The money that would otherwise be lost to fees stays invested and continues to generate returns. Even a 1% difference in annual costs can add up to hundreds or thousands of dollars over the years, which shows why choosing low-cost options is such a smart move. It is also worth noting that ETFs and index funds are widely accessible through most brokerage platforms, and many of them allow you to start with very little money. Some brokers even offer the option of buying fractional shares, meaning you do not have to buy a whole share if it is too expensive. This makes it possible for someone with just $100 to begin building a diversified investment portfolio right away. By choosing low-risk, broad market funds, you are essentially setting the foundation for long-term growth while keeping your risk level manageable. This approach may not make you rich overnight, but it provides steady progress and builds the habit of disciplined investing, which is the key to turning a small beginning into much larger financial success over time. Using the power of compounding by reinvesting profits is one of the most effective ways to grow a small investment into something much larger over time. Compounding works like a snowball effect, where the money you earn from your investments is reinvested and begins to generate its own earnings. This creates a cycle where your returns start earning additional returns, and the process continues to build on itself year after year. For example, if you invest $100 and it grows by 10% in a year, you now have $110. If you reinvest that extra $10 instead of spending it, the following year you earn returns on the entire $110, not just your original $100. This process may seem slow in the beginning, but as time goes on, the growth becomes much faster and more powerful because each round of profits adds more to the base amount that earns returns. The key to making compounding work for you is patience and consistency. The longer you allow your money to stay invested and continue reinvesting your profits, the larger the effect will be. Many beginner investors make the mistake of withdrawing profits too early, which interrupts the compounding cycle and slows down overall growth. By resisting the urge to spend your gains and instead letting them remain invested, you give your money the opportunity to multiply in ways that would not be possible otherwise. Even with small amounts, compounding can produce impressive results over time. What begins as $100 reinvested carefully can grow into thousands if given enough years to build upon itself. Another important part of compounding is choosing investments that consistently generate returns, even if they are not the highest in the short term. Safe, steady growth is often more powerful than chasing quick wins, because consistent returns allow compounding to do its work without frequent setbacks. Reinvesting dividends from stocks or interest from bonds is an easy way to keep the cycle running smoothly. Many brokerages also offer automatic dividend reinvestment programs, which ensure that any money earned is immediately put back into buying more shares without you having to take extra steps. This automation makes it easier for beginners to stay disciplined and avoid the temptation of using small profits elsewhere. When you focus on compounding, you shift your mindset from short-term gains to long-term wealth building. You stop worrying about getting rich quickly and instead concentrate on letting your money steadily grow on its own. This is how small investments like $100 eventually become $1,000 and more, not through luck or risky bets, but through the steady and reliable force of compounding working silently in your favor. Exploring fractional shares to invest in big companies with little money is one of the most accessible ways for beginners to enter the world of investing without needing a large amount of capital. In the past, if you wanted to buy a share of a company like Apple, Amazon, or Tesla, you had to pay the full price of one share, which could be hundreds or even thousands of dollars. For someone starting with only $100, that was nearly impossible. Fractional shares have changed this completely by allowing investors to purchase a portion of a share instead of the entire thing. This means that even if one share of a company costs $500, you can still invest $10 or $20 in it and own a small fraction. Your ownership may be smaller, but you still benefit from the company's growth and receive dividends proportional to the amount you own. The ability to buy fractional shares opens the door to investing in companies you truly believe in, regardless of their stock price. It also makes diversification much easier because you can spread your $100 across several large companies instead of being limited to one affordable stock. For example, with fractional shares, you could invest $20 each in 5 different well-known companies instead of putting all your money into a single business. This approach allows you to build a balanced portfolio even with a small starting amount. Many online brokerages now support fractional investing, making it simple for beginners to start small and gradually increase their investments over time. Another advantage of fractional shares is that they allow you to practice investing and learn how the stock market works without the pressure of committing large sums of money. You can observe how different companies perform, track your returns, and understand market fluctuations, all while keeping your financial risk low. This is especially useful for beginners who want to gain experience before investing larger amounts. The sense of involvement and ownership also encourages discipline, since you feel connected to major companies that you would not have been able to afford otherwise. Fractional shares also work well with automated investment plans. Many platforms allow you to set up recurring investments where small amounts of money are automatically used to buy fractional shares of your chosen companies or funds. Over time, this consistent investing builds up your holdings and takes advantage of market growth. By using fractional shares, beginners with limited money can start building wealth right away instead of waiting until they have hundreds or thousands saved up. It is a modern solution that makes investing more inclusive and provides a practical way to turn small amounts like $100 into a foundation for long-term financial growth. Staying consistent by adding small amounts regularly is one of the most important habits for turning a small investment like $100 into something much larger over time. Many beginners believe they need a big lump sum to start investing, but the truth is that steady, repeated contributions matter more than the size of the first deposit. This approach is often called dollar cost averaging, where you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. By doing this, you buy more shares when prices are low and fewer shares when prices are high, which averages out the cost over time and reduces the impact of market volatility. The key is not timing the market perfectly but staying disciplined with consistent contributions. Even adding as little as $10 or $20 each week or month can create powerful results when combined with compounding. If you start with $100 and then keep adding small amounts, your investment base grows steadily, and the returns on that growing base become larger each year. For example, contributing just $20 per week adds up to over $1,000 in a year, and when you combine that with the returns from your investments, the growth accelerates even faster. This habit transforms investing from a one-time action into a long-term financial routine that builds wealth steadily in the background of your life. Consistency also helps remove the emotional side of investing. When you invest regularly, you no longer worry as much about whether the market is at its peak or at a low point, because you know you will keep buying no matter what. Over time, this takes advantage of both the highs and lows, allowing you to benefit from long-term growth while avoiding the stress of trying to predict short-term movements. It also creates accountability, because once you set a routine, you are more likely to stick with it, just like any other good habit. Automatic investment plans offered by many brokerages make this even easier, as you can set up recurring deposits that take place without needing to remember each time. Another benefit of adding money regularly is that it makes investing more accessible for people with limited income. Instead of waiting months or years to save a large amount, you can start with what you have and build gradually. This approach also aligns with the reality that financial growth is rarely about big overnight wins but about steady, disciplined effort over time. By committing to small but consistent contributions, you allow your investments to keep working for you without interruption, and this continuous effort plays a critical role in transforming a small start into a meaningful financial foundation. Avoiding emotional trading and focusing on long-term growth is perhaps the most critical discipline every beginner must develop in order to succeed in investing. When you start with a small amount like $100, it can feel tempting to chase quick profits or react to sudden changes in the market. News headlines, social media discussions, or even a single day of market volatility can create fear or excitement, leading many investors to buy or sell impulsively. This behavior often results in losses because decisions are based on short-term emotions rather than sound strategies. Emotional trading can cause you to sell when prices are low out of fear or to buy when prices are high out of greed, which is the opposite of what leads to long-term success. Focusing on the long term means understanding that markets naturally go through ups and downs, but over extended periods, they have historically trended upward. By keeping your money invested and resisting the urge to constantly react to short-term fluctuations, you give your investments the chance to recover and grow. This patience is what separates successful investors from those who lose money quickly. Developing a long-term focus also means setting realistic goals and having a clear plan for your money. With time, those small amounts add up and grow into meaningful wealth, but only if you stay invested and let the process unfold naturally. Avoiding emotional trading also frees you from the stress and anxiety that come with constantly checking prices or trying to predict short-term outcomes.